And awesome. So again, the idea in all of it, right, is I just need to be able to track and see what they've done the last couple of years so that it can make sense as to why I'm lending that money to them, right? Knowing that they're brand new to the workforce, right? If they're getting in and we know what's going on, especially on a W-2, it's not terribly difficult, right? That's an easy explanation, right? Any questions on that?
1099 is not always just work related, right?
1099 is typically contract work, right?
Well, like if you sell a home, is it 1099 related to that in terms of taxes?
So you'll end up getting a 1099 form that you'll end up taking and reporting on your personal taxes, right? That is that's part of the reason why it's called 1099 income, right? And so at the end of the year, instead of receiving a W-2 for the work that you've done, you'll receive that 1099, and that's how you'll end up reporting that, right?
Okay. It was just mentioned to me because my aunt and uncle are actually selling a house right now in Mesquite.
Mhm.
And coming back up here to Utah, and someone mentioned to me, oh, you need to use like their 1099, figure out what the taxes are going to be. Is that right? Is that the right form? The 1099?
So a lender is going to ask for that 1099 form, because again, different programs are going to require different ways of documenting that income, right? I do have programs that allow for straight 1099 forms to be used rather than going off of tax returns. Tax returns are going to show a little bit more as far as like the deductions or the write-offs that they're trying to do on for their businesses, right? And so it's just a matter of the product that they're getting placed on and what's going on with it, right? So yes, the lenders will ask and do look for them.
Okay.
Okay. So getting into types of loans, right? VA, USDA, FHA, and then more conventional stuff like Fannie and Freddie, right? Again, these are all going to have pros and cons to them, right? There's not a loan product that is perfect for everybody, right? It's just going to be hard to try and find something that works for absolutely everyone, right? So obviously they're going to have some benefits, some things that just don't work nearly as well. And it's a matter of trying to fit into that. I call it a box, right? In order to be able to get into the house, right? Some are really focused on credit and credit score, right? Others are a little bit more lenient on, say, our debt to income ratio, right? Others do have limitations when it comes to how much money you can actually make, right? And more, right? So again, it's a matter of going through trying to figure those things out, right? Now, I'm sure as you've looked and have put offers out, right? Sending a pre-approval out saying that they've been pre-approved for a conventional loan is going to look a little bit different than say sending it out with an FHA pre-approval, right? Again, that's because people kind of are aware that there are differences between them. Conventional ends up being, let's call it a little bit more conservative in their way of approaching a loan and getting things qualified, right? You have to meet a certain standard in order to be able to get into those conventional loans. FHA, that bar isn't nearly as high, right? And so typically when buyers, sellers are looking at trying to figure things out, they like those conventional loans, but that's not to say that the FHA loan isn't a good product. It can very much be a good product, but there can be a little bit of apprehension behind it, right? Any questions on?
Okay, so my parents are thinking of buying a secondary,
Mhm.
but I know in some states there's like a mileage requirement, like how far away it's.
As far as second homes go? Yep.
Do you know what it is for each, or it's different for every?
Most lenders are going to say that any second homes need to be outside of a 50-mile radius of their primary residence, right? With the exception of, say, like a destination location. A prime example here in Utah would be second home up in Park City if you live here in, say, Orem, right? They understand that that's a kind of prime area. There's a lot happening up in Park City. And so that can be one of those exceptions, right? Where it's less than 50 miles away. But typically 50 miles is the radius, right? They don't want you to claim a second home in the same neighborhood. That's unrealistic and just doesn't work, right? Right.
And can you still use any type of loan, like an FHA, or does that have to be?
So when it comes to anything other than primary residences, FHA does not do those. FHA is strictly primary residence, right? They want you to, as the borrower, to be able to live in that property, right? So those are probably going to end up going more conventional in order to be able to qualify and work through them.
Still use USDA.
USDA, I believe, again, is also a primary only product, right? Same with the VA. Mhm.
So I'm always hearing people kind of talk down on FHA.
Mhm.
Why is that?
So, for example, right, the minimum threshold on a conventional product, so if we go Fannie or Freddie with it, is a minimum credit score of 620, right?
On Fannie and Freddie.
On Fannie and Freddie. In comparison, FHA, some lenders will go down to 580 on those, right? Meaning that there's more problems going on with that credit than,
No credit and it's 580.
uh-huh,
So
uh-huh. The other, right, is they are typically geared towards people who have a little bit lower of a down payment, right? And they do allow for greater debt to income ratios than a conventional loan, right? And so conventional will typically want to cap you out at about 45% of your income going towards servicing any and all of your debt, including the new house payment. Whereas FHA will go above that and go beyond that, 50 and in some cases up to 55%.
okay.
Yeah. So it ends up being something that is a little bit more catered to those who have a little bit more risk associated to them.
Okay.
Does that make sense?
Yeah. And with it, normally the interest rates are better, but the payment is more.
So there's a combination of different things that go into those FHA
Not
payments.
necessarily specifically that.
So interest rates do play a motivating factor in between the different products, right? But like you said, FHA could potentially be just as much or more than a conventional loan would be. Because FHA is going to end up uh, counting in their own mortgage insurance. They're still going to bring in their principal and interest payment, right? And the way that they calculate, the biggest difference is the mortgage insurance. And the way that they calculate their mortgage insurance is different than how it would be set up on a conventional loan, right? The other idea is those FHA loans, mortgage insurance is pretty much life of the loan. You're not going to get rid of it. Whereas like a conventional loan, as soon as it's paid down under 80% loan to value, you can drop that mortgage insurance. You won't continue to have to make that payment to mortgage insurance. Mhm. Yep. So again, a lot of different options, a lot of different things that are going to end up happening, right? And we talked through some of these things, right? Whether it be credit scores, sometimes it's bankruptcies even, right? As we're trying to figure out what to do and how to make those happen. Um, uh, Again, I'm going to kind of run past this one unless there's any questions on it. But again, these are things that we'll end up going through and figuring out, right? FHA also requires a little bit more documentation, especially when it comes to the appraisal in trying to get things put together, right? Same with the VA stuff. We'll go past this and we'll kind of land here, right? So the idea, right? A lot of people are going to look at it and say, well, my principal and interest payment should be the only thing that I have to worry about, or the only thing that we need to be aware of, right? And that's just not the case as I'm trying to put their ratios together. There's more that goes into what I call overall house expense than just the principal and interest, right? And I've kind of touched on those a little bit already, in that the property itself is going to have property taxes that are going to be associated with it, right? They're going to be able to go out and figure out what hazard insurance they need to be able to have in order to cover the property, right? Mortgage insurance, if it applies, right? And then again, HOA fees, even HOA fees get calculated into that house expense ratio. I need to be they need to be able to make sure that they've got enough money to cover those dues, right? So I'm not looking to try and stretch them beyond what they can realistically afford or do. So even HOAs need to be brought in. That is one of those things that I've gone back and looked at several different times. As you go and find properties that say have $200 HOA fees versus some I've seen lately as much as almost $600 in HOA fees, right? That makes a big difference in what they could potentially qualify for and look at, right? And so you'll probably end up talking to the lender probably specifically about HOA dues and how that changes any qualifications, right? Based on how they looked at that stuff. Make sense?
So I kind of have a question going back to the launch, just really
Yeah,
quick.
go for it.
So for Utah housing, so
Mhm.
is that FHA or is that something else?
Utah housing is a unique product, right? In that it is an FHA first, right? And the idea behind FHA is that they require a 3.5% down payment. That's the bare minimum, right? Um, what Utah Housing done is been able to come up with a way to be able to give them that 3.5% down without it coming out of pocket to them. And the way that they've done that is by setting up a second mortgage behind the FHA first in order to be able to cover those, right? So it ends up being 100% financed, right? Including closing costs, right? Up to a certain percentage over and above that 100%. But that's how they're essentially set up. Is it's an FHA first with a second behind them to cover all of those.
Because I know some sellers don't want to deal with that
Mhm.
So if you had that would still be.
Yep. Utah Housing is still considered more of an FHA product, right? Yeah, you're not skirting around anything or pulling the wool over anybody's eyes. They all pretty much know that it's an FHA product. Now that said, Utah Housing is rolling out here in the beginning of the month a conventional 100% down or 100% financing option, right? Which is awesome, right? There's a little bit that goes into it, right? They do need to be able to qualify on it, but it's going to be a very solid option.
So it's gonna be conventional with that help.
Yep, exactly. Yep. So Utah Housing will have not only their FHA option, but a conventional option as well, because conventional again needs to have their minimum down payment.
It's 5%.
It depends on what the program is. I'm pretty sure they're going to do 5%. I need to be able to see what their matrices are and how they're setting up those products, right? But they're rolling that out here soon. Yep, it'll be awesome. Okay. Do we know what mortgage insurance is? Private mortgage insurance. FHA is going to be is going to require it the entire time. FHA is going to be a little bit different, right? Depending on how much coverage you need and when you can drop it. Do we know what an escrow account is? Have you heard of escrows? Okay. The idea on an escrow account is it is an account set aside to be able to collect for the property taxes and the homeowner's insurance on the property each month, so that when they become due, that payment can be made to either the county or to the insurance provider for the coverage that they're doing. They're collecting that premium so that when that becomes due, they can make sure that it gets paid, right? Are they required on every loan? Meaning, as you make your payments to the bank, right? The bank is obviously going to collect the principal and interest payment, right? They can collect for the escrows so that gets set aside. Are they required to do that on every loan? No, they don't have to. The idea, right, is the amount of money that's being set aside into the escrow account, they do it more as a convenience to the borrower, so that they don't have to worry about it or come up with the money themselves. They've already set aside 1/12 of that each month, so that when they become due, they're ready to go, right? Some people do like to manage that and handle it all on their own, which is an option that's out there and available to them. The asterisk next to it is going to be, especially on a conventional product, If they're above an 80% loan to value, then 100% I have to escrow. I can't give them the option to manage that on their own. They need to be able to make sure that those property taxes are paid and the homeowner's insurance is paid, right? We want to make sure that those are up to date and stay happening for them. Okay. Any questions on that? Okay. Lending guidelines are out there and available, right? If you went on Fannie or Freddie's websites, those are things that you can access. It's going to be a super fun read, I tell you, right? If there's any questions to it, right, talk to a lender, talk to somebody who knows, and they can work through it, right? I'm gonna work through these relatively quick unless there's questions, right? But there's basically 4 parameters that I'm looking at when it comes to trying to qualify a borrower, right? We're looking at their credit, we're looking at what they're using as collateral for the loan, we're looking at what kind of capital they've got or the cash that they're bringing in, right? And we're looking at their ability or their capacity to be able to make those loan payments, right? So those are all looked at individually, right? So any one pillar needs to be able to stand on its own. But in order to be able to finance anything, they all collectively have to come together as a full picture of the borrower, right? So one of the things that I get asked all the time, right, is my income's not very good, but I've got a ton of assets. And can we make things happen just based off of a ton of assets, right? Well, if your debt to income ratio doesn't work and you've got a ton of assets, that means we're having to look at things in a totally different light than if your income actually supported the payment, right? In the end, I need to be able to make sure that you can make that payment. That's what we're looking for, right? Credit does matter, right? Credit is going to affect quite a bit. And yeah, my picture says that it prevents identity theft if you have a 350 score. Nobody's looking at you if you've got scores that low, right? The idea is that the lower your credit score, the more risk risk exposure for a lender that there is, right? And they'll use that in not only trying to qualify, but they're going to look at it as far as pricing, right? The higher your credit score, the better pricing I can offer when it comes to interest rates and what we're looking at that way, right? If you've got good credit, right, there's going to be a little bit more pricing than that'll go in than if you had very good to excellent credit, right? Again, it's just a matter of offsetting whatever risks that the loan application shows as a whole. Now there are minimum credit score requirements, right? Like I said, FHA requires at least a 580 score, whereas a conventional is looking for 620, right? And they need to be able to hit those thresholds in order to be able to do that. That said, for example, Utah Housing is 640 as a minimum credit score. So even though it's an FHA product, they require a little bit higher credit score in order to be able to use that and go with it. Again, capacity, their ability to be able to repay, right? A lot of that is going to look into where their work history is and their, it's going to look into their income, and it's going to look at what their monthly obligations are currently with the debts they're currently trying to service. Those monthly payments that they make to cars, to loans, to credit cards, to student loans, right? Even alimony and child support play a factor in and do get calculated into those ratios, right? And so as we're looking through loan products, right, I take into consideration all of these monthly payments in order to be able to determine what house payment they could potentially be able to afford, right? You'll notice in here though, things like utilities or cell phones or daycare, right? Those kind of things aren't included in this, right? Because those are things that I'm not necessarily worried about or looking at, right? What I'm more interested in is who they have obligations to, as far as loans out there that they need to make payments on.
I have a question about pairing up with the
Cosigner or co-borrower, okay?
So what if you're not
Bringing anybody in on the loan with you, you're more than welcome to bring on another borrower into the loan, right? The idea on it, right, is you want to bring somebody in who is more beneficial than detrimental to the loan, right? Because the idea is that, say if it was your loan, right? You're going to be looked at wholly and completely, meaning that your income, your credit, your funds available, right, are all going to be considered as a whole, right? Um, Same with the other person that you bring in as a co-buyer or a co-signer, right? Their income, their credit, their assets, their all of their information is going to be brought in, right? And looked at individually before they're brought in and looked at what I call globally, right? Looked at as a whole, right? Um, and so if you're going to bring in anybody, the suggestion is always going to be make sure that their credit is high enough, make sure that they've got the income to be able to support things, make sure that they're not bringing in any more problems than they're solving,
So
right?
let's say that you're getting a loan that you personally can't afford, but then
Hmm?
everything else is good. And that same thing with the other person.
Yep. Yep, that does work, right? Because, right, as you bring in everybody together, even though individually they may not be able to afford the house themselves, but combined they can, right? That happens all the time, right? Where prime example is husband and wife who are working together and each have a job, right? A lot of times they can't afford the house they're looking for unless I bring in their income together, right? Same idea when it's when it's a co-signer, right? Is they may not be able to afford it on their own, but together they can. More than capable of being able to do things like that, and especially right now with rising rates and rising purchase prices, especially for people who are first-time home buyers, it is one of those things that we're having conversations quite a bit with in order to be able to get into a house, right? Um, yeah, it's very much one of those things that we deal with on a daily basis.
And this is the last question.
Go for it. No, you're okay.
So I had a friend. So he has some friends that bought a house that they all went in together. They're just
Mhm.
friends. They have three. So three is still fine. Is there a max of how many?
Typically, they won't go above 4. Mhm. Yep. So I'll give you an example, right? Is I had 2 couples, husband and wife on both sides, right? Come in and they wanted to start doing investment properties together, right? And so between the 4 of them came in and they started purchasing investment properties and very easily able to make that work and make that start happening for them, right? Anything beyond that, it becomes too much, and they're not looking at trying to go beyond 4 borrowers. If you can't make it work with 4, there's more going on.
There's something that you look for more specifically when it comes to the amount of money coming in, or kind of like proof that they have that they can pay off debt. Between the two, do you feel like that there's something more going to accept compared to the other? Is that
No, I don't know that I'm tracking. What do you mean?
so? Like when you're looking at someone who is applying for something, right?
Mhm.
And he came up with the example that they might not be making enough money, but they have enough. They don't. They might not be making enough money, but they have proof that they can pay things off. They bring someone else on who has money, to supply for what they're missing.
Mhm.
Do you feel like that there's something you're looking for more of?
Not necessarily looking more for of. I just need to make sure that as a whole they can make it happen, right? So maybe an example, right, would be a kid going to his parents, asking parents to help co-sign, right? A kid may have saved up enough to be able to come up with the down payment, but doesn't have the funds to be able to, or doesn't have the income to be able to support that monthly payment. Mom and dad come in because they do, right? Provided that mom and dad in the overall ratios, including kids' debts, can support that new house payment. Kid can bring in his funds and use those funds. We don't have to ask mom and dad for additional funds to be able to make that happen, right? That's the combined effort that comes into all of it, right? So it's not that I can't cherry pick what I like from one to the other. I just need to make sure as a whole it makes sense and it works.
Okay.
Does that make sense? Does
Yeah,
that answer?
So, yeah. So
Okay.
like person A has a ton of money coming in with bad history, but then the other person doesn't have a lot of money coming in, but they have great history, it would kind of just cancel it out?
Not necessarily, right? So if somebody has bad credit history, right, that's going to reflect in their credit scores. And that does become one of those things that they still need to be able to have scores high enough themselves to be able to qualify. And the idea when it comes to pricing is it's going to be based off of whoever has the lowest of the middle scores, right? And so because somebody is brought in with lower credit, pricing is going to be based off of that, right?
So it's more based off of a threshold rather than, oh, this person has great credit, so we're just gonna go off.
Yeah, again, I can't cherry pick from one to the other, right? The full picture is going to be taken into consideration.
Is that the same case, all of this that we're talking about with commercial?
Commercial is a totally different animal. It's a totally different animal, right? And I don't do any commercial lending, right? I'm strictly residential, 1 to 4 unit properties, right? Commercial is something totally different, and you'll end up working with financial institutions, bank and credit unions who will end up doing more commercial stuff. I don't do them as a mortgage broker. Yep. And commercial, depending on where they go and who they end up doing the loan through, are going to have their own parameters on what they're willing to accept or not. Okay. Collateral is just the house that they end up getting and using, right? The majority of the time, I want to make sure that it at least shows value, right? And it's worthwhile accepting as collateral, right? I which means that it has to be in decent enough condition to be able to live in and function, right? Windows shouldn't be knocked out, right? There shouldn't just necessarily be holes in the walls or the carpeting and flooring ripped up, right? That doesn't necessarily work, right? Nor is it necessarily anybody that a buyer is going to want to move into immediately if that is the case with damage going on, right? A lot of these things, right, you'll probably see along the way that a lender is going to ask sellers to satisfy certain things, right? Whether it be patch up the hole in the wall or whether it be, put a little bit of paint on exposed wood, right? Whatever. We ran into it all, right? And those will be things that the lender will communicate back to you guys as far as figuring things out. But collateral means that collateral is the way that as the money is getting lent out, if it ever needs to be recovered, that's what they use in order to be able to recoup that money, right? And so they want to make sure that it's decent enough to be able to use as collateral for the amount of money that they're putting in or allowing to be financed, right? Okay, and then capital is that money that you have to play with in order to be able to make the transaction work, right? Sometimes it's none, and there are options for 0 down payments, right? The more capital that you've got, the more options that are out there and available, right? And those will end up opening up an array of products and loans and different things that they could potentially qualify for. And then it's a matter of working with what fits best and what works, right? Again, that can come from not only their funds for down payment, but they do get credit, right, for any earnest money that they put towards the property, right? So just because they put earnest money down doesn't mean that it's just disappeared and gone. I do credit them for having put that into the property so that they're not having to come up with $5,000 or $10,000 more at closing just because they put that in upfront. They'll see that credit gets applied. Okay. Any questions here? That was a long way to get into processing and underwriting, and I'm sorry, right? Those are the parameters that we go through in order to be able to get that pre-approval process done, right? So part of the reason to go through that much is to show you guys that those pre-approvals do mean quite a bit once they are put together and once they're done, right? I've verified quite a bit with them. I've looked at a lot of different things. I've put together quite a bit of the file and structured it in such a way that we know that once a house is under contract, that it's ready to go. And we can move that into processing and into underwriting, right? We'll keep things moving along a little bit, but processing and underwriting, once you do have a contract put together, is the next step, right? I've already somewhat structured that loan in the pre-approval process to make things happen. And then it's a matter of trying to get things moving along so that final verifications are happening and loan documents are being generated, right? The idea is that first things to be done once a house is under contract is get things like the appraisal ordered, get title work ordered, try and start figuring out what homeowners insurance is going to be, right? And these are going to be things, right, that you're going to want to make sure that you're aware of and potentially giving people the heads up of as kind of the next steps as to what's going to end up happening, right? Because most mortgage companies are going to say and tell them that they need to have the funds available to pay for the appraisal up front. Everything else, as far as closing costs goes, get collected at the end when they sit down to sign closing documents. But they're going to be asked to pay for an appraisal up front. They need to be aware of that and know that that's going to be a thing once they do go under contract, right? And you guys will end up working with appraisers, whether it's trying to get them into the house or trying to give them access to whatever they're looking for, right? Especially on listings, if you're showing listings. Underwriting. There's a couple different things that go into underwriting. One of it is what I call an automated underwriting system, which is an AUS. The idea is that as I plug in a file or a scenario into my system, it'll shoot me back a report as to what they're picking up on as anything that's required or needed in order to put the loan together, right? It's just something that happens automatically, right? It'll tell me what verifications need to happen. It'll tell me what the type of appraisal that needs to be ordered. It will tell me what kind of, say if I need reserves to be verified, right? Additional funds beyond just closing costs that need to be verified, right? That is all part of it, right? And those are things that as we ask for conditions from the borrowers to satisfy, because I do quite a bit up front, but that doesn't necessarily mean we've gotten everything, right? I've done enough to be able to hopefully get them out the door shopping. And then once they do pick up home, we'll fine tune it from there, right? Which is what processing is going to do all the way along. They're going to make sure that everything is done fully and completely so that an underwriter can look at it and give us final approval on how things have been set up and how things are looking, right? Once you get that approval from the underwriter, then you're good to try and get closed and get things funded, right? Which is in everybody's eyes, the best day of the entire process, right? Is to be able to sit down at that closing table and be able to sign those documents and get funding going, right? For you guys, and what you'll want to pay attention to is they do need to make sure that they're showing up with photo IDs and do have those available. I've had people show up with expired driver's licenses. Doesn't work, right? They need to be able to show some identification and current identification, right? That'll be one of the things that you'll probably end up running into and warning people of as you get them over to the closing table. You'll also want to make sure like wiring instructions. Again, as a lender, I'm also saying these things, right? But having it come from two different sources, right, really means a lot to people. And if they're hearing the same thing that I'm saying as an echo, it really helps them know, yeah, this is just needs to happen, right? Especially if it's the first time going through and doing things, right? So the idea is that we'll coordinate with you guys, with doc preparers, everybody, in order to be able to schedule those closings and get that all to happen and make sure that that's coming together in the end so that it feels like a slam dunk for everyone, right? From there, after the loan is closed, after the loan is funded, right? That means that you as the realtor get to be able to put the keys in their hands and say, this home is now yours, right? And that's fantastic to be able to do that. The next step, right, is, okay, now that that's all done, what's happened? Where prime question is going to be, where do I make my payments, or when is the first payment due and what's happening with it, right? Who is the one who is going to service that loan, take those payments and make sure that things are taken care of, right? And that's exactly what ends up happening immediately after closing is it gets taken and put with a loan servicer to be able to manage that and look through everything. And they'll get notices in the mail of where those payments are going to be made. There are some lenders who have the servicing themselves, right? A lot of the lenders that I work with, right, do service their own loans. Sometimes they get sold, right? I'm sure you guys have heard of, starting with one lender, but then it gets sold to a different servicer, somebody that they haven't worked with and haven't done any business with prior to that point, right? Uh, that's just the way that things go on the market, right? Depending on who wants to either buy up that mortgage or whoever wants to try and maintain the servicing to it, right? So just because it gets transferred to a different servicer doesn't mean that they're any less obligated to that loan. They still need to be able to make those payments. At the same time, it doesn't change any of the parameters that they've been set up on. So interest rate isn't going to change, payments aren't going to change, when they're due is not going to change, right? All of that's going to maintain the same. They just need to know who to make that payment to. Okay. Any questions on that?
What would be the biggest reason for a switch?
For a switch? Um, Depending on if a bank wants to sell it or not, right? Yeah. If a financial institution decides that they want to free up or sell assets, right? Mortgages are considered an asset, and they can sell those and sell the servicing rights to somebody else to maintain those.
So they would normally be doing it because they're like free up space?
Potentially. Yep. The institution that I came from serviced all of their stuff. They wanted to maintain those servicing because they're able to feel like there's better customer service behind some of that stuff. There's already a face associated with it. Some of these more national companies, that's not necessarily what's happening, right? And one of the driving factors of it is you got great pricing up front when it came to closing costs and interest rate, right? Which is a huge motivating factor for a lot of people, right? And so whoever takes that payment isn't necessarily going to drive that decision in the end, right? They just need to know who that's going with, right? That said, there have been instances where servicing, once they are landed with somebody, I've come back and refinanced because I know who's going to end up servicing later on if I refinance it and do it to help them into a better situation, just because customer service or whatever, right? Any questions on that? Is that all semi-coherent? Okay. It feels like the floodgates open, right? And it's a lot of information. I've probably talked super fast through some of it, right? But there's a lot that goes into mortgage lending, which is why getting your feet wet and at least having some working knowledge of it is beneficial to you. But 100% the reason why you don't want to field those questions, you want to send them back to a mortgage loan officer, somebody who can answer those questions, because there's just going to be a lot more that can be answered and done if you do, right? It's not the hat that you wear as realtors, it's the hat that I wear as a lender. Just like I wouldn't tell anybody how to structure a contract or put things together on your end. That's not my hat. I don't want to be doing that. I'm not telling anybody how to do those. I leave that to you guys as kind of experts in your field to be able to make that happen. And then I figure out how to facilitate it, right? Okay, so again, the idea in all of this, and this is where I get to make my plug, right, is being able to partner with the right lender is super important, right? We're gonna push through some of this. Being able to partner with the right lender is super important, right? As you, especially on those pre-approvals, right? You want to make sure that you've got somebody who does go through some of these processes so that it doesn't become a mad scramble in the end in order to be able to pick up those pieces and see if it still works, right? That's one of the big benefits of Introlend is us going through those pre-approval processes and being able to look through all of those, along with the relationships that we've got, not only with the brokered options that I have available to me, whether I wholesale the mortgage myself, or if I work with the partner lenders that are on our platform, right? Whether that be First Colony or Intercap or Security National Mortgage or whomever else that we've got there on the platform. Right now there's over 40 different lenders that are on our platform that you can kind of select through. If there's relationships that you've built with lenders, let's have them talk, right? The idea on my end, beyond just getting them through that pre-approval process, is to also help them to be able to shop and figure out what is out there and available as far as market rates and closing costs and the rest of them, with the entire intention of it takes a lot of the weight and stress of them submitting in multiple applications and their documents to multiple lenders. If they'll send them into Introlend, I can do that legwork for them. I take their basic information and shop that between the different lenders, so it does feel like a one-stop shop for them, right? That also helps with you guys in being able to make sure that as they're collecting bids back, they're working with lenders that you're already aware of and already know and are comfortable with, right? So that if they do select somebody to go with, you already know what that relationship is and what's going on with them. It makes it really, really nice on your end to be able to know potentially who they're going with, rather than just picking, say, like an online mortgage lender or somebody that you've never heard of, right? You want a little bit of confidence to be able to know that the loan is going to close. Because not only do you want to help your client be able to figure that out, but I mean, realistically, we're all looking for a paycheck at the end of the day. You want to make sure that that paycheck's coming, right? So hopefully that gave you information as to what mortgages are, what's going on with it. Have you guys downloaded the Introlend app? Have you played around with it at all? If you'll scan the QR code, that will give you the app. And it's easy to be able to plug in your phone number and get registered with it and start figuring things through. The biggest suggestion that I've got as you do that is to put yourselves through as a test, just so that you can see exactly what's going to end up happening and what's going on with it, right? You'll end up getting emailed and text a link to the online application, and it's an individualized portal specific to your client that you're working with, where they can enter in their information, they can start uploading their documents, and they'll start seeing the communication coming back and forth between Introlend and themselves. The other nice thing is it also keeps you guys fully in the loop as to what's going on and what's happening. So as I work through something in update notes, it'll update there in the app and let you know what's going on, or say like I need something more from them, it'll give you the notice that I'm still trying to collect different things from them, so that you're not guessing as to, hey, what's happening, what's going on, how come I haven't heard back in a couple of days, right? That's designed so that it keeps you fully in the loop as to what's going on, right? The other nice thing, right, is I've got a concierge team working behind me that will help work through and help people get through that application process as we're trying to work through and get things done at the same time. So you'll want to be aware, right, that as you put somebody through the app, they're probably going to get a call from an 800 number. That's just like, again, my concierge team following up, making sure that they did see that app, were able to access it, could start filling things out for me, and then I'll follow up with them. Any questions as far as mortgages go?
So I forgot if it was you that had a client that was like this.
We probably all have had a client like what you're gonna say.
So
Okay.
it was a guy who's super rich, you know, had $1 supercar payment.
Okay. Okay.
But when trying to buy, I think it was just another home, just investment property, something like that. With all the taxes he had, he was one of his taxes, so
Mm-hmm.
that his income was shown super low.
Yep.
Or it really wasn't.
Yep.
So how do you work around? He just has to weigh it.
There's different ways to be able to show things and do things, right? The easiest way is to be able to show it off of tax returns, right? But there are other options. We can do what are called bank statement loans in order to be able to show that income and work through things like that. That is one of those things that I'm pretty confident in how to calculate income coming off of those bank statements. Any lender is going to be reasonably competent in being able to do that. That said, it is not totally uncommon for underwriting to come back and say that they calculated something totally different, right? So it is very much one of those things that I would put through with an underwriter to look at first before we just had them go out looking for something, right? I want underwriting to be able to tell me what they're coming up with their income, and I can challenge that to an extent. But underwriting is ultimately going to have final say as to what they're calculating. So options, right? Are they necessarily the best of options? No. Bank statement loans are considered a little bit more risk. The interest rates are going to be a little bit different, right? But the options, right? If they were to go and do something along those lines.
I was just wondering that because I was thinking like how would you go about if your taxes were
Uh-huh.
on paper show that you made $30,000 that year, but obviously more than that, you have $1,200 car payment.
Yeah.
So I was wondering.
That's not to say that coming off of the bank statement loan, that that's a full guarantee as to what's going on, right? Because they are going to look at what the expenses are coming out of the account at the same time, and they'll consider all of that as they're trying to figure things out and make things happen, right? So it's an option. It's still trying to figure out if it qualifies. Yep. Any other questions? Is that, again, feel like the floodgates just opened up? Yep, I get it. Let me know if there's any questions, if there's anything that I can do to help or help answer questions. More than happy to do that kind of stuff for you guys. That's the relationship that we've got here with Keller Williams, is to be able to be a resource to you. So take full advantage. I'm more than happy to, my door's open to you guys. Or call, text, whatever. Happy to give you whatever information you're looking for to see what we can get done.
And your office is like kind of
I have actually moved all the way upstairs. I am right next to Carl Spencer's office.
which is Shoney's old.
Yep, exactly. Yep. Okay. Does that work? Okay. Look at that. We kept it at almost an hour. We're good. Okay, guys. I sure appreciate it.